Look at this chart. Price makes a high, then forms two lows. Two lows? That's enough to draw a trend line.
And wait for the third touch. Price comes back to the line. Long entry. Stop loss below the previous low. Target at the previous high. Simple. But then, price breaks the trend line, hits the stop loss, and closes the trade. And guess what happens next? Price goes straight up and hits the exact target. The direction was right. Why did the market hit my stop loss and then go exactly where I expected? Well, let's find out.
Let's test this on another chart.
Before we start drawing trend lines, there are three things I want you to keep in mind. First, trend lines with a more moderate slope, around 45 degrees, tend to be more sustainable.
When a trend line becomes extremely steep, it usually becomes harder for price to maintain that angle. So, yes, it may break. But that does not automatically mean the trend is over. You still need to look at the major highs and lows. Second, the more times price touches a trend line, the more important it may look, but that doesn't mean it becomes unbreakable. In fact, the more obvious a level becomes, the more traders may start watching it and placing orders around it. So, more touches can also mean more attention and more potential liquidity around the level. Now, let me switch to the 15-minute time frame and see what we could find. All right, let's see what's happening here. This one looks interesting. We have a clear uptrend. Now, imagine you were watching the market right here. Price has already created two clear lows. So now, we can draw our trend line. Something like this. And now we wait for the third touch. Here it is, the third touch. Now, look closely. What happened? A lot of traders probably saw this as a long opportunity. Price came down to the trend line and then closed back above it. So the trend line appears to be holding. Looks bullish, right? But look again. What do you see below this low? And below the trend line? A lot of obvious stop loss areas. Traders who bought here may place their stops below this low. Other traders may place their stops just below the trend line. And now we have a very obvious area where many orders may be sitting. So what happens next? Price drops. It breaks below the low. It breaks below the trend line. And now, a lot of traders may think, that's it. The trend line is broken. Some long positions are stopped out. Some traders may even enter short after the breakdown. So now we potentially have two things happening at the same time. Long traders are being forced out, and new short traders are entering. But then, look at what happens. Boom. Price reverses and moves straight back up. The trend line break was not the end of the uptrend. It was the reaction after the break that mattered. Now, does this mean a bank definitely came in and hunted every single stop loss here? No. No, we can't know that just by looking at a chart. But we can see something important. This was an obvious level. Many traders could see it. Many traders could react to it. And when traders behave in similar ways, orders can become concentrated around the same areas. That is the part we need to pay attention to. The trend line itself is just a line. The real question is, where are the orders? And what does price do after reaching them? So instead of blindly buying every third touch, we can start looking for areas where liquidity may be concentrated. Then we wait. We wait to see what price does when it reaches that area. Does it break and continue? Or does it take the obvious liquidity, reject the level, and move back in the opposite direction? That reaction is what we want to study. And if we get confirmation after the sweep, we may be able to look for a trade with a smaller stop loss and a larger potential target. But remember, a wick by itself is not a signal. A trend line break by itself is not a signal. The reaction after the break is what matters. So that's the basic idea behind what a trend line really is, and why the reaction around it can be more important than the line itself. Of course, there is a lot more to talk about. There are different types of trend lines, different market conditions, and many other ways to read liquidity and price action. If you want me to continue this series, let me know in the comments. And if you want to study this yourself, go back through your charts, especially on the 15-minute, 1-hour, and 4-hour timeframes. Look for clear trend lines. Mark the obvious highs and lows. Where would most traders place their stops? And what happened after price reached that area? You may start seeing these patterns everywhere. If you have any questions, drop them in the comments. Thanks for watching, and I'll see you in the next one.